Hi everybody. In the last video, we began our discussion of periodic pension plan expense. In this video, we'll continue that discussion. Another component of pension plan expense might be amortization of prior service cost. As discussed in a prior video lectures, increases to the PBO resulting from retroactive application of a plan amendment is referred to as prior service costs. In our example, there was a $60 million increase in Global's PBO due to recalculating benefits employees earned in prior years as a result of the plan amendment in 2020. The prior service cost must be amortized over the remaining service life of active employees, beginning in the year the plan was amended. The average remaining service life of employees in this example is estimated to be 15 years. $60 million divided by 15 equals amortization of prior service costs of $4 million per year. And remember, this plan was amended in 2020, so the first $4 million of amortization happened in the year 2020. That means that at the beginning of 2021, the unamortized balance of prior service cost is $56 million. That's the $60 million resulting from the plan amendment in 2020 minus $4 million of amortization in the year 2020 leaves $56 million balance at the beginning of 2021. And that's where this $4 million of amortization of prior service costs came from. Be sure to note that even though we're amortizing it, the prior service cost is not an asset, but instead it is a part of accumulated other comprehensive income, also known as AOCI, which is a shareholder's equity account. This is a result of the FASB's disinclination to treat the cost as an expense as it is incurred. The Financial Accounting Standards Board instead prefers to consider it to be other comprehensive income, and like the handful of losses and gains also categorized this way, it is not reported among the gains and losses in the traditional income statement. So prior service cost is reported as a component of accumulated other comprehensive income. And over the years of remaining service life for our active employees, a piece of that prior service cost captured in other comprehensive income is expensed to pension expense. So that over a period of 15 years in this example, it gets reclassified from accumulated other comprehensive income into expense, which is used to calculate net income on the income statement. And when the expenses are closed, they close to retained earnings. So as prior service costs are amortized, they move out of the other comprehensive income, which is an equity account, into retained earnings, which is also an equity account. By using the straight line method, prior service cost is recognized over the average remaining service life of the active group of employees. Prior service costs, as stated before, is not expensed as incurred. Instead, it is reported through other comprehensive income, closed to AOCI, amortized over time through pension expense. Thus, we calculate the prior service cost at the end of 2021, which is an AOCI account, to be $52 million. That's the beginning balance of $56 million minus the amortization in 2021 brings the balance down to $52 million. Now let's spend some time with amortization of net gain or loss. As previously mentioned, gains and losses can occur when expectations are revised concerning either the PBO or the return on plan assets. Like prior service costs we just discussed, we do not include these gains and losses as part of pension expense in the income statement, but instead report them as other comprehensive income in the statement of comprehensive income as they occur. Theoretically, gains recorded in some years would cancel losses recorded in other years. However, as we will discuss in a few minutes, if the accumulated net gains or net losses exceeds a certain threshold, that excess is amortized to pension expense over time. We report gains and losses, net of subsequent amortization, on a cumulative basis as a net loss AOCI or a net gain AOCI, depending on whether we have greater losses or gains over time. We report this amount in the balance sheet as part of accumulated other comprehensive income, AOCI, which is a shareholder's equity account. There is no conceptual justification for not including losses and gains in the income statement earnings. After all, these increases and decreases in either the PBO or the plan assets immediately impacts the cost of providing a pension plan and, conceptually, should be included in pension expense as they occur. Nevertheless, the FASB requires that income statement recognition of gains and losses from either source, meaning the PBO or the plan assets, should be delayed. Let's work another concept check problem. Brendan Health Services reported a net loss AOCI in last year's balance sheet. This year, the company revised its estimate of future salary levels, causing its PBO estimate to decline by $24 million. Hint: this is a gain with respect to the PBO because it causes a decrease in the company's liability, which should be viewed as a gain. When a liability decreases, it results in a gain. Also, the $48 million actual return on plan assets was less than the $54 million expected return. Hint: this is a loss. We expected a higher return on plan investments than we actually got. So, as a result, A, the statement of comprehensive income will report a $6 million gain and a $24 million loss, or B, net pension liability will be increased by $18 million, or C, accumulated other comprehensive income will be increased by $18 million, or D, net pension liability will decrease by $24 million. Please pause the video, use these hints, they will help you, and do your calculation and select your answer, then start the video again to check your work. The correct answer is C. Accumulated other comprehensive income will increase by $18 million. The $24 million gain and the $6 million loss combine for a net gain of $18 million in this year. which reduces the prior net loss AOCI, which results in an increase in AOCI. If the loss is reduced in AOCI, it results in an increase to AOCI. And by the way, the journal entries would be debit projected benefit obligation, $24 million, credit gain OCI, other comprehensive income, $24 million, debit loss OCI, $6 million, and credit plan assets, $6 million. Well, that's all for this video. In the next video, we'll conclude our discussion of the details of periodic pension expense. See you next time.